We're going to talk about the yield curve. The yield curve is sometimes in the news for being weird, but we have to step back a bit to understand what is normal, what's weird, and why it all matters. Spoiler alert, when the yield curve is weird, people worry that that means a recession could be coming. So step back to understand the basics. In lesson 1 of this class, we talked about discounting the value of money at some future date. The present value is going to be lower as the interest rate rises. An amount of money, W, paid T years in the future is going to be worth W divided by 1 plus R to the T power. As R rises, the present value is going to fall. Now, bonds are a series of payments of money in the future, not just providing one payment, but instead a whole series of multiple payments at multiple future dates. So bond valuation is a bit more complicated, but it's the same bottom line. As interest rates rise, bond values go down, and vice versa. As interest rates fall, bond values rise. We say there's an inverse relationship between bond prices and interest rates. As rates go up, bond prices go down. There are cases where changes in risk are always going to be important. Bonds can have different risks depending on who's promising to pay the money. But U.S. government debt is considered to be about as low risk as you can possibly find anywhere in the whole financial system, anywhere in the globe. Then we add the Fisher equation that we've talked about. The nominal interest rate is the sum of the real interest rate plus the inflation rate. The short formula is I, the nominal rate, equals R, the real rate, plus pi, the inflation rate. Now, in our simplest cases, we talked about the interest rate, but the real world's more complicated. There are slightly different interest rates for different dates in the future. Money to be paid 1 year from now is discounted at a different rate than money paid 30 years from now. This is the term structure of interest rates. Usually, longer time horizons have a higher interest rate. If you're buying a bond paying a rate of interest over the next 30 years, you probably want a little higher rate because you're locking up some money for 30 years. Versus if you just buy a bond for 1 year, you're only locking it up for 1 year. Small investors understand this. If you were to go to a bank and look at their rates for CDs, certificate of deposit, you'd find the longer you're willing to lock up your funds, the better the rate is going to be. That's called the yield curve term structure. There are different market interest rates for different maturities. At the beginning of this class, we made an assumption there's just the interest rate. But now we're going to add some more complexity and note there are a lot of different prices for somewhat different maturities. They're commonly quoted for 1 month, 2 months, 3 months, 6 months, 1 year, 2 year, 3, 5, 7, 10, 20, 30 years. You can lock up your money into a bond for just overnight or 1 month, all the way out to 30 years. Now, normally, yield curve has an upward slope. Normally, if you're going to lock away your money for a long period, you got to expect to get a little more interest paid. The biggest market for bonds is the bonds issued by the U.S. government called treasuries. Other bonds are typically priced relative to those. Some borrower that is not the U.S. government, maybe a giant multinational corporation or New York State or California, those bonds are going to be priced relative to treasuries. So here are two yield curves. The one on the right is relatively normal. There's an upward slope. The one on the left, the most recent, is quite flat. Short rates are about the same as the long rates. We recently got out of a yield curve inversion. This graph shows the yield curve from a year ago where shorter rates were higher than some of the longer rates. That's weird. Not only is it weird, it's also concerning to a lot of economists because an inversion often happens before the economy goes into a recession. Prior inversion was 2019 and the economy did have a recession in 2020. Now, granted, the 2020 recession had nothing to do with the yield curve inversion. The bond market was not predicting COVID. Still, coincidence. There are a lot of theories about where COVID came from. I haven't heard anybody say it was because of the yield curve. But the inverted yield curve was signaling the economy was looking weak, and so people were worried. The yield curve had been inverted last year and is still quite flat, suggesting there's some weakness in the economy, some reason for worry. Now let's look at a graph from our old friends at Fred. This is the 10-year rate minus the 2-year rate. We can see that most of the time it's greater than 0. The 10-year rate is higher than the 2-year rate. The yield curve is inverted when that difference turns negative. The graph shows previous recessions as gray bars. We can see that at the beginning of that chart back in the late 1970s, the yield curve inverted as the line went negative, and there was a double dip recession. Those two gray bars very close together. Then the yield curve went to normal as that double dip recession ended and stayed normal till it inverted again, and the 10-year rate minus the 2-year rate went below 0, and there was a recession. Then the yield curve went back to normal for a few years before inverting again, followed by a recession after that. Then the yield curve went normal for a while, inverted again, and then the big 2008 financial crisis recession. That's that really wide gray bar in that chart. That recession lasted a long time. Yield curve went back to normal before inverting again. We had the short COVID recession. Then the yield curve went weird again, with the difference falling below 0. And people have been wondering, is there a recession coming? Or is that a false alarm? We will see. If I knew, I'd tell you, or I'd make a lot of money one or the other. This graph looks at just the last 5 years to better show recent times. After the COVID recession, the yield curve steepened, but then mid-2022 it went negative as the Federal Reserve began raising short-term interest rates. It stayed negative for a while, but recently rose up, and now the 10-year rate is above the 2-year rate, although sagging back down. Has the economy dodged a recession? Has the Iran war shoved it over the edge? We're all waiting to see. Now, why? Why does an inverted yield curve signal there may be a recession in the forecast? It's not actually anything particularly scary. It's just showing expectations of people in the market. And not just any old people, but expectations of sophisticated and well-capitalized people who track these things all the time for their career and have substantial incentives to get it right. The yield curve inversion shows that market experts think in the short term interest rates will be higher than over the longer term. And, in the news, the Fed has indeed raised interest rates, but then paused due to all the uncertainty. The Fisher equation says the nominal interest rate equals the real rate plus the inflation rate. So if that's low, that means some combination of real interest rates and inflation rates over the next 10 years are expected to be lower. But the Fed increased short-term interest rates. One way to get both the real interest rate and the inflation rate lower in the future is a recession. So an inverted yield curve does not cause a recession, just like roosters don't cause the sun to rise. It's just a signal. The market expects there's a substantial probability there might be a recession in the near term. And historically, that's been a pretty good predictor. But it's not 100%, and so we will see if there is a recession coming at some point in the future or near future.